Okay, so you want to own a solar farm, rows of panels turning sunlight into electricity, a guaranteed buyer in the local utility, and a government handing you a tax credit worth nearly a third of the entire project just for building it. It sounds like the closest thing to free money in this entire series, clean, quiet, and backed by federal policy instead of foot traffic or a fickle customer base. Here's the problem. In June 2025, one of the largest solar financing companies in the country filed for Chapter 11 bankruptcy, carrying more than $10 billion in debt, just weeks after the federal government pulled a $3 billion loan guarantee it had promised. So what actually happened? Here's the idea that explains almost everything else in this video. A solar farm isn't really an energy business. It's a tax credit timing and land lease business. And running electricity onto the grid is almost a formality bolted onto a much bigger financial structure underneath it. There are three real versions here. Utility-scale solar farms are the largest, sometimes covering hundreds of acres and exceeding a gigawatt of capacity, selling power directly to utilities or grid operators under long-term contracts. Community solar projects sit in the middle, typically 1 to 5 megawatts, serving a set of local subscribers rather than a single utility buyer. And residential or behind-the-meter solar sits at the smallest scale, financed and owned entirely differently from the other two. This video is about the utility-scale format, the one actually reshaping entire electricity markets. Utility-scale solar now costs somewhere between $0.80 and $1.60 per watt to build, not including land. A 1 megawatt farm runs $800,000 to $1.6 million. A more typical 50 megawatt project needs $40 to $75 million in capital before it generates a single kilowatt hour. Land adds another layer entirely. Leasing typically runs $1,000 to $5,000 per acre per year, while purchasing land outright can run anywhere from $1,000 to over $80,000 an acre, depending on the state and how close it sits to existing transmission lines. Site preparation, grading, drainage, fencing, and access roads adds $5,000 to $20,000 more per acre. This is capital intensive from the very first shovel of dirt, and almost none of it is optional. A 1 megawatt solar farm typically produces 1,500 to 1,700 megawatt hours a year, enough to power around 200 homes, but that number depends entirely on something called capacity factor, the gap between a panel's rated maximum output and what it actually generates once you account for clouds, seasons, and the fact that the sun sets every single day. Almost none of this power is sold on the spot market. Instead, most utility-scale farms lock in a power purchase agreement, a PPA, with a utility for 15 to 25 years at a fixed price, essentially trading away the upside of a good year in exchange for predictable revenue a bank will actually lend against. The PPA isn't a detail of this business. It is the business, since almost nothing else about the deal gets financed without one. Here's the part of this industry almost nobody outside of it sees coming, and it's one of the strangest structural problems in this entire series. As more solar gets built in a region, the value of every individual solar farm's electricity, specifically the electricity produced at midday, starts to fall. Grid operators call the resulting demand pattern the duck curve. Electricity demand dips in the middle of the day exactly when solar output peaks, then spikes again in the evening exactly when solar output disappears. When enough solar farms are generating at once, the grid can end up with more electricity than anyone needs, and operators are forced to curtail output or let prices go negative, meaning a farm can actually have to pay to keep running rather than get paid. California alone curtailed 3.4 million megawatt hours of solar and wind power in 2024. In other words, the better solar succeeds as an industry, the less valuable each individual farm's midday output becomes, a kind of cannibalization that has nothing to do with a bad location or bad management, and everything to do with too many farms doing the same thing at the same hour. There's a quieter economic story running underneath all of this for the people who own the land these farms sit on. A farmer leasing 100 acres to a solar developer at even a modest rate can earn a steady $30,000 to $500,000 a year, often more reliable than the crop yields the same land used to produce, without touching a single panel themselves. It's one of the only parts of this entire business that looks close to genuinely passive, because the risk of the electricity market, the equipment, and the financing sits entirely with the developer, not the landowner. For over a decade, developers built their entire model around a 30% federal investment tax credit, extended through 2032 under 2022's Inflation Reduction Act. Then, on July 4th, 2025, Congress passed the One Big Beautiful Bill Act, which sharply accelerated the credit's expiration for solar and wind specifically. Under the new law, a project only qualifies for the full credit if construction begins by July 4, 2026, or if the project is placed in service by December 31, 2027. Miss both deadlines, and the credit is gone entirely, not phased down gradually the way earlier law intended. On top of that, projects starting construction in 2026 face new Foreign Entity of Concern sourcing rules, requiring a rising percentage of components to come from outside a list of restricted countries, including China, a country that currently supplies the large majority of the world's solar panel components. For an industry where the tax credit can represent close to a third of total project value, this single piece of legislation didn't just change the numbers on a spreadsheet. It changed which projects get built at all, and triggered a nationwide rush to lock in construction start dates before the deadline closes. Take that 50-megawatt farm costing $50 million to build. At a 30% investment tax credit, the effective capital need drops to roughly $35 million. Producing around 80,000 megawatt hours a year and selling it under a PPA at $35 per megawatt hour generates about $2.8 million in annual revenue, against operating costs that industry estimates put at a relatively low $15,000 to $25,000 per megawatt per year, since a built solar farm has no fuel to buy and very little that can mechanically fail compared to almost any other business in this series. On paper, that math works out to a payback period of 12 to 15 years. It works precisely as long as the tax credit arrives on schedule, the PPA price holds, and curtailment stays manageable. Change any one of those three assumptions, and the entire model shifts underneath the same physical rows of panels. Look at what happened to SunNova Energy. Built into one of the largest solar financing companies in the country, primarily in residential and lease-based solar rather than ground-mounted farms, SunNova had secured a $3 billion Department of Energy loan guarantee, described at the time as the federal government's single largest commitment ever made to solar. By early 2025, the company was carrying $10.67 billion in long-term debt against just $13.5 million in cash. In March, SunNova warned investors it had substantial doubt about its ability to continue as a going concern. The following month, the Trump administration canceled that $3 billion loan guarantee outright. Weeks later, SunNova laid off 718 employees, more than half its entire workforce, and on June 9, 2025, filed for Chapter 11 bankruptcy, with its stock delisted from the New York Stock Exchange the same day. After a 155-day restructuring process, the company's own bondholders ended up acquiring substantially all of its assets for roughly $118 million. A company that had listed liabilities as high as $50 billion sold off for a fraction of a percent of that number. SunNova's model wasn't identical to a utility-scale farm's, but the underlying lesson transfers directly. An entire business built on the assumption that government support and cheap debt would keep flowing on schedule can collapse the moment either one doesn't, regardless of how much physical solar capacity actually sits in the ground. In the good year, construction began before the July 2026 deadline. The tax credit was secured in full, the PPA held at its contracted price, and curtailment losses stayed within the range the original financial model assumed. On a 50-megawatt farm generating $2.8 million in annual revenue, a healthy operating margin puts around $2 million a year toward paying down that $35 million effective investment. In the realistic year, nothing dramatic happens at first. Regional solar build-out continues nearby, and curtailment during peak midday hours creeps up a few percentage points beyond what the model assumed. New Foreign Entity of Concern compliance paperwork adds unexpected legal and sourcing costs. The original PPA is still years from expiring, but a portion of output has to be sold on the merchant spot market during high curtailment hours, at prices that occasionally go negative. None of it makes headlines on its own, but annual cash flow compresses from $2 million towards something closer to $1.2 million, stretching the payback period by several years on the exact same panels, producing the exact same electricity under the exact same amount of sunlight. That's the business. Nobody is really selling sunlight. They're selling a spot in line before a subsidy clock runs out, and that clock, not the weather, is what actually decides whether the farm gets built at all.